Great. Hello, good afternoon, everyone. My name is Janice, and I am the director of the Low Income Taxpayer Clinic here at Maryland Volunteer Lawyer Service. And I want to thank you all for joining us on this very gloomy Tuesday. I hope you are all staying dry. We are going to get to our speaker momentarily, but I just wanted to discuss a couple of logistics issues and encourage everyone to follow us on social media. If you are not already a volunteer at Maryland Volunteer Lawyer Service, we do encourage you to join us, especially on our tax panel. We do invite CPAs as well as enrolled agents to assist with our clients because we recognize that all of us are able to represent clients before the IRS. So Victoria, if you'll go ahead and advance to the next slide, please. Great. So for those of you interested in joining us and looking for ways to do pro bono cases, I do want to direct you to our pro bono portal, and that is located on our website. And Victoria, if you'll move to the next slide. This is what it looks like. So our cases, our available cases are grouped by categories, and the tax category is the blue tab over on the right side there. On that, you'll be able to see any available cases that we have, and we do encourage you to join our pro bono panel in assisting these low-income taxpayers who may not have any ability to get representation otherwise. So, okay, next slide, please, Victoria. So I am going to turn it over to Victoria in a moment here. I want to let everyone know that Victoria is one of our very wonderful volunteers, and she takes on cases, she's taken on quite a few cases for us. So thank you so much for that, Victoria.
Of course.
And let you know that Victoria is going to, has also generously agreed to allow us to post the slides as well as this audio tape on our website afterwards. And just a reminder that these slides and the audio tapes are available to our volunteers, and as well as a library of many other of our webinars and trainings as well. So without further ado, I'm going to let Victoria take over from now. Thank you.
Well, thank you, Janice. Hello, everyone. My name is Victoria Kelly. My law firm is Victoria Eve Kelly, LLC, specializing in tax controversies, including individual and small business audits, offers and compromise, installment agreements, lien removal, innocent spouse, and filing back tax returns. I also handle estate planning, including wills, international wills, and trusts. I'm a certified chapter instructor for the Maryland, Delaware, DC chapter of the National Association of Tax Professionals and a member of the board of individual tax preparers. The presentation today is Airbnb, Know Before You Rent Out, and we'll be talking about the tax treatment of Airbnb and short-term rentals.
Oh, one thing I forgot to mention. Yes, Victoria, I'm sorry. I forgot to mention for anyone, if you do have questions, we are going to ask that you go ahead and write in your questions in the box so that we can see them. Go ahead and write them in as you're thinking of them, but we will probably wait until the end and hold the questions to discuss them towards the end, just so we don't interrupt the flow of the discussion. So thanks again, Victoria.
Sure. Just to give you a little context, Airbnb and short-term rentals are part of the gig economy. You may not have known that you were living in the gig economy, but we all are, and it's characterized by a prevalence of short-term contracts and freelance work as opposed to permanent jobs. And hold on. Yeah, there's something obscuring the screen. The gig economy is fueled by technology, which includes the online platforms like Airbnb that bring people together who offer goods or services with others that need such goods or services. Now that's interesting. I am running into a technical issue. The slide is not advancing.
Oh, there we go.
There it is. Yep. As you can see from this chart, which dates back to 2016, but I think it's representative, non-employer firms in blue are growing faster than conventional employment firms. Rides are prominent in that, but so are rooms. And there are other statistics that would tell you the same thing. The gig economy is global. Workers, particularly millennials, travel widely for work very often. Millennials who work around the world call themselves digital nomads, and they often stay at Airbnbs all around the world. Now, Airbnb and short-term rentals in the DC metro area generally will allow an owner to use a primary residence to earn income. So that older clients can use the cash for investment or can stay in a primary residence after retirement, and younger clients or the offspring of older clients might want to buy or rent a slightly larger property than they need with features suitable for a short-term rental to use the extra money to save or pay down the mortgage. But Airbnb and short-term rentals have created controversies. So inns are not new. Even before Airbnb, travelers who didn't carry their own tents and bedding might find shelter at the inn, and we know the biblical story of Mary and Joseph who couldn't and therefore had to stay in a manger. But what's new is the scale and the competition Airbnb is mounting to both traditional hotels and conventional real estate leases, which has created controversy on both fronts. Where the hotels complain that they have to meet commercial codes, Airbnb rentals don't, and entrepreneurs who buy housing stock for short-term rentals are depriving the community of more affordable single-family residents and apartments. Short-term rentals also disrupt occupancy and zoning regulations. What if a house is in an area zoned for single-family residential housing? A short-term rental is arguably a commercial use. What if a home or unit only has a certificate of occupancy for a single family? Renting a room in that property to a second family arguably violates the certificate of occupancy. And so rather than banning Airbnb outright or allowing it without restriction, many jurisdictions have forged compromises. And the DC metro area jurisdictions have passed compromises with similar features that include a license and registration with an average $150 cost, a limitation on the rental to a primary residence, limitation on the number of days the property can be rented, which may differ depending on whether owners are home. The hotel taxes are paid by the guests and they're submitted to the municipality by the owner, or as you'll see later, under legislation newly passed by the House, not yet passed into law, the platforms are supposed to collect and remit. Condominium and homeowners associations, at least in Montgomery County, don't seem to have many restrictions against short-term rentals. And what one investigator told me in Montgomery County is that the time for resolution of a complaint is so long that the owner's rental is often long over by the time the dispute is resolved. So getting into more of the substance of it, we need to understand for tax purposes the difference between a lease and a license. As most or all of you will know, income from real estate leases is passive per se, with the exception of real estate pros and active management. It's reported on 1040 Schedule E. Income from Airbnb and other short-term rentals, as we'll discuss, are typically licenses, not leases, and they're considered a business, generally reported on 1040 Schedule C, subject to self-employment tax, where losses may be offset against other non-passive income. Digging further into what a lease or a license is, you'll recall from your studies that the owner of an estate in fee simple enjoys the full bundle of sticks, including rights of possession, control, exclusion, enjoyment, disposition, and may also transfer one or more of these sticks. So if they transfer the stick that permits exclusive possession, then they have created a tenancy, which is an interest in land. And the landlord, once that tenancy is created, may only enter to demand rent or make repairs. However, an owner in fee simple may also grant a license, allowing another to do something on the owner's land. A license is not an interest in land, it's a permissive use. And so the owner who grants a license hasn't transferred any sticks in the fee simple bundle. A mere permission to use land where dominion over it remains in the owner and there's no exclusive possession that's been given is a license. And if the language used in agreements purports to give another the right to use the land only for a specific purpose, and there's nothing to show an intention to give the right of possession, there isn't a tenancy. The difference between leases and licenses has consequences in a variety of contexts, among them taxation. Income from a leasehold or a conventional real estate rental is taxed one way, income from a license or a permissive use is taxed another. Some background, again, we go back to the Tax Reform Act of 1986, which was intended in part to curb tax shelter activity by publicly traded partnerships that sold ownership interests to real estate to passive investors who purchased these ownership interests for the deductions. Before the act, investors could use these deductions to offset unrelated income like salary or portfolio income. The investors were otherwise uninvolved with the real estate itself. So after the Tax Reform Act of 1986, income from a rental trader business that a taxpayer did not materially participate in is passive income. The deduction of passive losses is limited to the amount of passive income, and most real estate rental activity is passive per se, even if the taxpayer does materially participate. And we noted earlier the exceptions. So what a typical real estate lease looks like is, among other things, that it's typically for 1 or more years. It can be for months or even a 30-day month to month. Whereas a rental arrangement is not a real estate lease if the rental is 7 days or less, or it's accompanied by substantial personal services. And these are features typical of Airbnb and other short-term rental arrangements. As the Senate report accompanying the act made clear, operating a hotel or similar transient lodging where substantial services are provided is not a real estate rental activity. Looking more deeply at the duration of a rental, if it's 7 days or less, it's a license or permissive use, not a conventional real estate leasehold. The rules impose, in effect, an irrebuttable presumption that a taxpayer offering the property for 7 days or less is providing services substantial enough to justify the conclusion that the person is engaged in service business rather than a rental activity. Under the regulations, if a rental is more than 7 but not more than 30, it could be a license or a leasehold, depending on whether the taxpayer provided significant personal services. So calculating the duration of rental or the average period of customer use, you add all the days the customers use the property during the year and divide it by the number of periods of customer use, defined as each period during which a customer has a continuous or recurring right to use the property. So if the average period of customer use is 7 days or less, the rental is going to be a license. I say probably a license here, that's sort of a hedge. If it's a real estate rental of 7 days or less, it's going to be a license, but it's never going to be a lease. If the average period of customer use is 8 days or more, you look at whether substantial personal services were offered. If yes, the rental is likely a license. If no, depending on the party's intentions, the rental could conceivably be a lease. Duration of rental is one factor in determining whether it's a real estate rental or service business. Provision of substantial personal services is another. And substantial personal services are those offered primarily for the renter's convenience, like regular cleaning, changing linen, or maid service. IRS publication 527, Residential Rental Property, discusses this in detail. Substantial services don't include services similar to those customarily performed in high-end commercial or residential rental property, like cleaning and maintenance of common areas, routine repairs, trash collection, etc. Another yardstick that's a little more obscure is the value of the services provided relative to the amount charged for the use of the property. That value is measured by the cost to the taxpayer of employees performing such services. So where maid and linen services, in one example provided by the regulations, cost less than 10% of the amount charged for rent, the services are not significant enough to remove the rental from the category of a short-term real estate rental. Actually, I should say, are not significant enough in and of themselves to remove the rental from the category of a real estate rental. I think I meant here a lease. I'm sorry for that unclarity. So that alone won't distinguish that particular rental from a conventional real estate lease. But that's just one indication. So to sum up, a real estate lease is an interest in land. It gives a tenant an exclusive right of possession, one of the sticks in the bundle of sticks that characterizes fee simple ownership. It's usually for at least 30 days. It's not accompanied by substantial personal services. It produces passive income and does not require the payment of self-employment tax. It's reflected on Schedule E of Form 1040, and if the safe harbor requirements are met, real estate rentals constitute a trade or business entitling a pass-through entity to a 20% deduction under Section 199A of the Tax Cuts and Jobs Act. Whereas an Airbnb or other short-term rental is a license giving the guest a temporary right to stay on the property for a particular purpose. It's not a transfer of an exclusive right of possession or of any other stick in the fee simple bundle. It lasts 7 days or less, or it may last more than 7 days if accompanied by substantial personal services. It's a service business. It's reflected on Schedule C of Form 1040. It's non-passive. It requires the payment of self-employment tax, and if the service business is performed as a pass-through entity with material participation, the pass-through entity may be eligible for a 20% deduction under Section 199A of the Tax Cuts and Jobs Act. Miscellaneous tax issues include the requirement for Form W-9 and Form 1099. Airbnb, HomeAway, and other platforms collect rental income directly from guests without involvement from hosts. Based on that rental income collected, the companies will submit Form 1099 NIS to the host pursuant to IRC Section 6041, which requires businesses to report payments to individuals of more than 600. To avoid backup withholding, which is now 24%, hosts should submit Form W-9, a request for taxpayer identification number and certification to the companies collecting the rent. Occupancy taxes, also known as lodging tax, room tax, sales tax, etc., are imposed by states and municipalities. They're paid by guests, but the hosts collect the taxes and remit. Some companies, including Airbnb, collect and submit the taxes on the host's behalf in various jurisdictions. And since occupancy taxes are paid by the guests and are not the host's expense, they are not deductible from income or reflected on the host's tax return. Now, Maryland has a 6% sales tax. Various counties have a room tax. Those are the taxes we've just referred to. Montgomery County, for example, has a room rental and transient tax of 7% of the listing price of the room, including cleaning fees. As we discussed, these taxes are paid by the guests, but they're supposed to be collected and remitted to the state or municipality by the platforms. In Maryland, House Bill 884, passed in 2019, proposes to make it mandatory for platforms to collect and remit. If the booking is not made through the platform, then the guest will pay the taxes to the host, who will in turn remit to the municipality and state. Guest fees are charged by Airbnb and other companies. also known as guest service fees for use of the platform. Airbnb advertises this fee as 5 to 15% of the price for the room. Since this fee is paid by the host, it's deductible as a business expense and reported on the host's tax return. Value-added tax is not something we pay in the U.S. It's payable in Europe. Just to explain briefly what it is, it's a consumption tax. It's assessed on goods and services as they travel through the supply chain. If a miller sells flour to a baker, the baker will pay a VAT. The baker bakes the bread, sells the loaf to the supermarket pays a VAT. And so in Europe, a host, and I think in Japan, a host will pay a VAT on purchases for the business, and the guest will pay a VAT on room sales or rentals. But that is not something we need to worry about in the U.S. So if you have a client that's got property overseas, an overseas specialist should be consulted. So now, as we've discussed, rentals fall into two categories. One is leases. That's a conventional real estate leasehold. The other are permissive uses, which are your typical hotel and Airbnb use. Now, permissive uses fall into two categories. The first are the short-term rentals that we've just discussed and described. The second, however, will be vacation rentals. And for tax purposes, we need to understand short-term rentals as having different rules from vacation rentals, which are kind of their own animal. Vacation rentals are a hybrid rental activity that reconcile two tax provisions. The first is IRC Section 212-2, which permits deduction for the management, conservation, or maintenance of property held for the production of income. The second is IRC 262A, which prohibits deductions for personal living or family expenses. So this hybrid rental activity is governed by IRC Section 280A, which governs rental activity of a dwelling unit that's also used as a personal residence for more than 14 days or 10% of the days the unit is rented, whichever is greater. The dwelling unit can be a house, an apartment, a condominium, a mobile home, houseboat, or the like, any place where you might live. A dwelling unit as a vacation rental does not include any part of the property that's used exclusively as a hotel, motel, inn, or similar establishment. So if one room and bathroom are devoted exclusively to Airbnb or other short-term rentals, they're taxed as such. And that one room and bathroom are not taxed as a vacation rental. However, if clients live in the house for 6 months, travel to Florida for 6 months, and rent the house for short-term rentals during the 6 months they're away, then the rental income will be reported as a vacation rental. So we have different rules from leases and short-term rentals for vacation rentals. If there are no personal services offered by the vacation rental, it's reported on 1040 Schedule E. But the passive loss limitations do not apply. So this reporting is different from the reporting for a conventional real estate leasehold, which is passive income unless there are exceptions. Here, the vacation rental that's reported on 1040 Schedule E is not subject to passive loss limitations, and that sets vacation rentals apart from conventional real estate leases. If there are personal services provided, the vacation rental is reported on 1040 Schedule C. It's subject to self-employment tax, and expenses are deductible per the IRS tax court rules and only to the extent of income. Expenses that exceed income are carried over, and the methodology for deducting and carrying over expenses sets vacation rentals apart from other Schedule C businesses. So expenses for vacation rentals are deducted in stages. First, you subtract indirect expenses, including mortgage interest, real estate taxes, and casual losses, which are going to be apportioned to the vacation rental for the time that it was rented and separated out for that property for the time it wasn't rented. And remaining indirect expenses not apportioned to the vacation rental are deducted on Schedule A. From whatever income is left over, expenses directly related to the rental are apportioned and subtracted, and these calculations are explained and illustrated on the next couple of slides. So what we're going to do, and I depict this on a chart as well. I'll go over it here, but again, these slides are going to be made available for you to refer to, because I know being exposed to this either for the first time or more likely as a review may still not quite be enough to cement it. So you're going to take expenses indirectly related to the rental, like mortgage interest, real estate taxes, and casualty losses, and multiply them by the following fraction: the number of days rented over 365, and the result is subtracted from rental income. Remaining indirect expenses are deducted on Schedule A. Now, the rental income less those indirect expenses, as you've just calculated them, yields income available for deduction of direct expenses, which are multiplied by the following fraction: number of days rented over total number of days used for any purpose. Subtracting that result will yield the income, if any, to offset depreciation. Now, the IRS uses a slightly different fraction. They use the same fraction to allocate all expenses, indirect, to income, number of days rented versus total number of days used for any purpose. These calculations are illustrated below, and they assume the taxpayer uses the dwelling unit as a residence for 30 days during the year and rents it out for 60 days. Real estate taxes on the home are $8,400, mortgage interest is $3,000, utilities are $350, and maintenance expense is $1,650 with depreciation $7,000. So here's a chart which gives all of this in detail. Now, I would note that the methodology used by the IRS tends to leave more income to carry over than the tax court or Bolton methodology. But since many software packages permit the Bolton method of apportioning, subtracting taxes, I think it's generally accepted by the IRS. Now, there are some management companies which specialize in short-term rentals. And for clients who don't want to handle the details of booking, cleaning, and so forth, management companies are an important resource. And the management company can consult with the owner or perform all rental duties, charge a percentage of rental income. These agreements are largely non-negotiable for your clients who are interested. And I think having tried to go quickly through this discussion, I've ended up with far more time than I expected. So I'm going to hand this over to Janice and hand things over to anyone who has questions. And in particular, if anyone wants more information on the different methodologies for apportioning taxes, I'll be glad to supply information later on in writing.
Great. Well, thank you. Well, for anyone who has questions, please go ahead and write them into the question box. This was a whirlwind tour through the world of Airbnb.
Yeah.
A lot of information. So,
yeah.
thank you for the
I'm sorry.
comment.
I think Right. I think I rushed it thinking that this was going to be longer than it was. So my apologies for rushing, but as I say, I'll be glad to follow up with further information on any subject that anyone would like it on.
Sure. Great, great. So again, if anyone has any questions at the moment, please go ahead and put them into the, go ahead and type them into the question box, and then we'll be able to discuss them. In the meantime, I do want to respond to a question about the slides as well as the presentation. The presentation will be recorded and available on our website to our volunteers. For those of you who are not currently volunteers, we do welcome you to join our volunteer panel. We work with pro bono clients who primarily in the area of income tax controversy, but it's always helpful to have some additional information, especially in a topic like this where more and more people are getting involved in it, and it's not really exclusive to one group of people versus another. So I hope you can take this information and utilize it towards perhaps some of our other clients who are involved in the gig economy. So we do have one question, Victoria, here. Let's see. It says, I'm a little confused about the expenses being deductible only to the extent of income. In the beginning, I thought the losses were deductible to offset income.
What we're doing is distinguishing short-term rentals that are not vacation rentals, meaning short-term rentals where the property is used only for short-term rentals and isn't lived in, from vacation rentals where the property is lived in for over 14 days during the year. If the property is a short-term rental and not lived in, then typically losses can be deducted against other income. But remember, permissive uses constituting short-term rentals can also be vacation rentals, which for tax purposes are sort of another animal. And if it's a vacation rental, then expenses can only be deducted to the extent of income, and then they're carried over. So the difference is going to be between short-term rentals writ large and vacation rentals. And if you go back over the slides, you'll see where I break out the discussion of vacation rentals from the other short-term rentals. Does that help a little bit?
So it says, so don't purchase port-held sheet sets if your room fee is low. Thank you, yes.
Wait, say that again?
It says, so don't purchase port-held sheet sets if your room fee is low. I'm assuming that's an expensive type of sheet set, perhaps.
Oh, okay. Well,
thank you for that.
Many people who rent on Airbnb and have management companies, and that's a lot of them, will actually rent the sheets. But yes, I think if you're concerned about whether expenses will exceed income, that's probably good advice to follow.
Wow, I didn't realize you could rent sheets as well. So many new things going on in this economy.
Right. Well, the management company, I didn't go into much detail about that because we were supposed to be focusing on tax, but management companies step in for short-term rentals, whether they're conventional short-term rentals or they're vacation rentals, and they will take care of all these details soup to nuts. And so many owners prefer to work with a management company because they communicate with the guests, they do the cleaning between rentals, and they do a host of other things that many busy hosts don't want to be bothered with.
It certainly seems like it would be easier then. But then in terms of that, the hosts are then paying a fee for the management company, and so
they will. They absolutely will. And
that's an expense to them.
It is an expense, and the management companies will often charge between 15 and 25% of rent, although I found one management company as low as 9%. So they are a significant expense.
But then does that make it easier in terms of not having to itemize some of the smaller expenses? Like you were saying, that instead of having to purchase sheets, do you just pay like one fee to the management company, and then that includes things like sheets and other expenses that you might otherwise need to deduct individually if you were doing it on
Yes,
your own?
absolutely. Absolutely. I'm sure the bookkeeping is much easier if the management company is taking care of a lot of it.
Yeah. Well, there's so many complications and so many different ways this can go. It's very interesting.
Right.
Definitely. So again, if anyone has any further questions, please feel free to go ahead and put them in, and we have some time to discuss them. Because this is something that I think a lot of people are interested in doing, and it seems like I don't have much experience with this myself, but it does seem like it's very common for people. Like I know people in my neighborhood will just rent out a room, like if they go away on vacation or something. And
right.
so it's much. It seems to be a pretty easy thing to get started on if you have a room to rent, or if you're going away on vacation and want to rent your home or something like that. So and often I'm sure that many of those individuals who are thinking about renting don't understand the potential consequences and other things going on. So we do have a question about how to proceed. And I'm not sure if you could elaborate on that question on how to proceed on how to proceed in what direction. That would be helpful for the question. There's another question about where does one apply for the license? Is it arranged through the platform? Is that something that you know, Victoria?
Yeah, you would apply through you would apply through the municipality, and so probably Googling your particular jurisdiction will help you get started finding where you purchase the license from. I had slides for a different discussion on the different DC Metro municipalities. I didn't include it here because it wasn't really a tax discussion, but there are going to be offices in the particular municipalities, and you make your way to those and get their requirements.
Okay. And then so if someone is, I'm going to assume that this is like anything else in tax where an individual decides they want to do this, and then they don't really think about the consequences or the tax ramifications until later in the year. But if you knew someone who was going to be doing this going forward, or is there any specific advice that you would give them, as opposed to meeting them later on in April when they come to you and they're looking for stuff?
I mean, that's a very good question. And that's something that I'm working through myself, because I think they probably should consult beforehand so that they can talk with you about how it's likely to be taxed. I think that some people are very much taken by surprise to discover that their self-employment tax on the income, they're not counting on that because they think that this is a real estate rental. And so that is certainly something to warn them about, because I know there are cases where people haven't taken out self-employment tax and the platforms certainly don't do it. And then they receive a notice from the IRS that they owe it. And so that's certainly an issue to focus on, one of the bigger ones. And and so, I mean, that first and foremost is the issue to grapple with. And then just knowing that they're not, knowing whether or not they're going to be able to take all their expenses against current income. If they pay self-employment tax on a conventional short-term rental, that means they are going to be able to offset losses against other income. But for a vacation rental, that's not going to be true. And so they should understand that consequence as well. And those would be the two main issues I would focus on in discussing this with them.
So here's sort of a practical question. Are internet, cable, Netflix, and other subscription services deductible for the number of days that room is used? So can you, like, apportion, I guess, can you apportion your, those services, some of those sort of household services to that specific area? I guess it's kind of like a home, like if you were to have a home office kind of thing.
Yeah, yeah. I mean, I would find some reasonable basis for apportionment, and then absolutely apportion it to the rental. Sure.
Okay, great. So
here's another. Might be square. Okay, I'm sorry.
I'm sorry. Go ahead. Say that again, please.
I was just going to suggest a reasonable basis might be square footage, for example. But, you know, as long as it's a reasonable basis, and I would disclose that, I would disclose your reasonable basis on the tax return, so that you're not leaving a question about why you're deducting, what you're deducting, and how you calculated the amount. I mean, say it so that an auditor doesn't have to ask a question later.
So then if, say, you were renting a room in your home, you would take the square footage of that home versus the entire house, and then maybe then multiply it by the number of days that the room is being used for the year or something like that.
But yeah, something along those lines, just some reasonable basis for apportioning the particular expense to that room. Really analogous, you're correct, to a home office, and then disclosing it.
Okay. And then it would only be deductible for the number of days that the room is actually used, do you think, as opposed to, since it's not like a hotel room that is only the only purpose of that room is being utilized for guests. I guess you could only ascribe those services to when the room is actually being rented out.
Yes, I mean, it would have to be limited to, if you're going to take it as a business expense, then yes, you would have to apportion it to the square footage and to the time rented. Again, some reasonable basis for apportioning it. But yes, you know, you can't take it as a business expense for the whole year if it's only a business expense for some fraction of the year.
Okay. I have another question. It's a sort of a specific question. I have a client that started on Schedule E. Oh, I'm sorry. I have a client that I started doing Schedule E, doing Airbnb renting starting in 2015. Things weren't so clear back then on whether to report on Schedule C versus Schedule E at that time. Now, knowing this activity should be reported on Schedule E, any suggestions on moving forward?
I'm not sure I understand the question. So this started out, you know, like a lot of people, I would think, putting it on Schedule E, and it's, from what this person understands now, the rental should probably have been reflected on Schedule C. And so what to do going forward?
Yes. So it looks like they started on Schedule E. And so I think what you're saying in your presentation is that it should be reported currently on Schedule C versus E. Is that correct?
Well, it depends. I mean, most short-term, most short-term rentals are going to be Schedule C. Short-term rentals that are also vacation rentals may be Schedule C or maybe Schedule E, depending on whether personal services are offered. So you always have to kind of distinguish. It really is confusing, but you have to distinguish a short-term. First, you're distinguishing a conventional real estate leasehold from a short-term rental. And then for the short-term rental, you're distinguishing the conventional short-term rentals from the vacation rentals. And different rules pertain. So without knowing the specifics of this person's client's rental, I don't know which schedule it should go on. But if this person's judgment says that it probably is a Schedule C, then, if that's what they believe now, then, they need to, I guess, figure out how to perhaps transition reporting. I can't speak to that in the abstract.
Well, I guess perhaps the general question would be that if it should have been reported on a Schedule C, but in the past it's been reported on an E, whereas perhaps it should have been on a C, but because it wasn't really clear before as to which one it should have been on, would you need to go back and amend those previous returns to get them on the correct schedule? Or could you say, well, now we understand how this works and there's more clarification in which schedule to use, and so going forward we'll just use the correct one? I mean, would there be a problem with leaving it alone versus would it be important to amend the previous schedules? And does it really make a difference, I guess?
Yeah, I can't really answer that except to say that the only response I can really give is the response that I'm supposed to give, which is that if it wasn't reported correctly before, yes, you're supposed to go back and amend. And that's really the only response I'm able to give.
Okay. Very good. All right. Well, it does sound like it is rather confusing as to which schedule to use, and it seems like this would not be an uncommon issue.
No, it's very common. And this talk came out of an article that National Association of Tax Professionals asked me to write because people were confused about how to report. And, I think, and I feel a little apologetic, that maybe having tried to move quickly through the slides, thinking I was going to bump up against more of a time issue than I did, didn't allow things to sink in slowly and therefore more clearly. But if you go back over the slides, I think you'll see the distinctions I'm drawing between a short-term rental of an Airbnb, for example, that's used as a rental continuously, or a rental under the vacation rental rules, where it isn't just one room, for example, that's rented continuously all year, or it isn't just a house that's rented continuously all year. It's a room or a house that's rented for part of the year but lived in for part of the year. Once it's lived in for part of the year, that is more than 14 days, it's probably a vacation rental. And so those rules kick in. If it's not lived in for part of the year, if it's property that's rented continuously, then it's not taxed under the vacation rental rules. Then it's taxed under what I've described as the short-term rental rules, which are different. But I think if you flip through the slides, you'll see that distinction drawn, and that may help you clarify it.
Victoria, are you able to go back to that slide since we have a little bit of time?
Okay.
Are you?
Absolutely. Okay. Now here we have leaseholds, which are real estate leases, and that's rental income that's always reported on Schedule E, versus the permissive uses, which is what an Airbnb rental is. And so you have, under the permissive uses, you have short-term rentals and you have vacation rentals. And here I think, is where the distinction really is drawn. It's not a vacation rental if the property is used exclusively as a hotel, motel, inn, or similar establishment. So if one room and bathroom are devoted exclusively to Airbnb or other short-term rentals, they're taxed as such and not as vacation rentals. But if the clients live in the house for 6 months, travel to Florida for 6 months, and then rent for that 6 months they're away, then it's a vacation rental. And that's true even if it's not a whole house. If it's a room that the clients rent for a while, but then when they're not renting it, they live in it. It's not used exclusively as a hotel, motel, inn, or similar establishment, then that one room is going to be taxed as a vacation rental. Does that help at all?
Great. Yeah, thank you. I think it's helpful to go back and look at this because it is very confusing, and it's nice to be able to see the section as well as the language and kind of and reviewing that again because it is very confusing. So thank you for trying to clarify it.
And the problem is Airbnb, and vacation away, etc., apply to both. It'll be an Airbnb whether it's taxed as a vacation rental or short-term rental. Airbnb doesn't worry about that. And so, they're all lumped together. But when it comes time to do the tax return, that's when you have to draw the distinction. Did the client use the room or the house for personal purposes for more than 14 days during the year? If so, it's a vacation rental, and that's how it's taxed. Or did the client not use the room or the house at all and just rented it for some portion of the year, in which case it's simply going to be a short-term rental and not taxed under the vacation rental rules.
Okay. So it's really not that straightforward. And so it sounds like you need to ask additional questions of your client to really try to figure out where it falls under. In order to try to make sure that you use the correct schedule and also just to report things correctly.
Right.
So it's very fact intensive and it's a case by case basis then. So
exactly.
One last comment.
Exactly.
Great. One last comment from someone who mentioned that she also deducted fresh flowers and dishes from the room. Would that be an acceptable deduction? Or an expense?
Well, was it a business? If it was a business expense, I would think it would be. I mean, if it's something that's attributable only to the rental and that otherwise you wouldn't be supplying the fresh flowers, etc. And it's the same judgment as with any other business expense. Is it a reasonable and necessary business expense? And if the decoration for the room makes it more attractive to guests, and it's a reasonable and necessary business expense, then I would think that it would be deductible.
Well, it sounds like the comment is that it did keep people coming back, so I would argue that it was a necessary expense, necessary and reasonable, since it did have people coming back. Probably the guests enjoyed that and appreciated that gesture, and it brought them back again. So it is a business expense, I would say. So
yeah, I mean, I think amenities to make the room attractive and competitive should certainly be considered as possible business expenses.
Great. Well, wonderful. Well, thank you. Anybody else who has a question, please go ahead and put them in. Again, this information will be available on our website to volunteers. For those of you who are not familiar with our organization, because I do see some new names here, we do welcome you to join our volunteer organization. What our low-income taxpayer clinic does is it provides pro bono assistance to taxpayers who have controversy issues with the IRS or the state of Maryland. It's something that you guys all probably do anyways. But we do have, if this is a new area to you, we do offer mentorship with people like Victoria, who can help direct you in terms of how to work with a client and what issues might arise and how to work with those issues. It's a very good learning experience and very educational, and it's a great way to get some experience if you're new to the field, or for those of you who already know how to do this stuff. It's a great way to get back to the community, and our clients are very, very appreciative of any assistance that they can get. So. Thank you all for joining us again today, and thank you, Victoria, for a very interesting and comprehensive discussion about this. I'm sure it will bring up many more questions.
Sure.
And for anyone who does have questions, feel free to email me, and I'm happy to pass them on to Victoria, and we can have further discussions about this. Victoria, I think on one of the slides you also had your contact information. If you want to head back to that slide.
Okay.
And again, for this information will be available on our website for our volunteers. So I do encourage you to join our volunteer panel, and we'll be following up with you and letting you know how you can join our panel and participate in and have access to all of our recorded trainings and webinars, as well as any future ones. So thank you again, and have a great day. Stay dry, everyone. Thank you, Victoria.
Thank you, everyone.
Thanks.
Bye-bye now.
Bye-bye.